You know, when you build something truly great, it all starts with a blueprint, a detailed plan that everyone can understand and agree on. Well, believe it or not, the entire global financial world runs on a blueprint of its own. It's a master plan that dictates exactly how we talk about money. So today, we're going to unfold that blueprint and see how the world of finance is actually built, right from the foundations up.
Okay, so picture this. You've got some money saved up, and you're thinking about investing in a company. They hand you their financial reports, and they're filled with all these big, impressive-looking numbers. But how on earth do you know those numbers are real? How can you be sure their definition of profit is the same one everyone else is using?
Well, the answer lies in something called the Conceptual Framework for Financial Reporting. Honestly, the best way to think about it is as the Constitution for accounting. It's the ultimate rulebook that makes sure everyone everywhere is speaking the exact same financial language. It's what makes those numbers you see consistent, reliable, and actually trustworthy.
Now, every good blueprint has to start with a clear purpose, right? So before we even get to the bricks and mortar, we need to ask the most basic question of all. What's the whole point? Why do we even bother creating these incredibly complex financial reports in the first place?
It turns out the objective is actually pretty simple and laser-focused. The entire system is built around one single word: useful. But useful to whom? Specifically, it's for the people putting their money on the line. We're talking investors, lenders, and other creditors. At the end of the day, it's all about giving them the right information to make smarter decisions with their capital.
Okay, so if the goal is useful information, that immediately begs the next question. What makes it useful? Just like a builder needs top-quality wood and steel, our financial blueprint needs information that has specific, non-negotiable qualities. These are what make it strong and reliable.
So the framework breaks these qualities into two main buckets. Over on the left, you've got the fundamental characteristics. Think of these as the absolute must-haves. Information has to be relevant, and it has to be a faithful representation, period. Then on the right, you have the enhancing characteristics. These are the things that take good information and make it even better, even more useful.
So let's talk about that first one, relevance. For information to be relevant, it has to be able to actually make a difference in a decision you're making. That means it either has predictive value, it helps you forecast what might happen in the future, or it has confirmatory value, which means it helps you see if your past predictions were on the money. If it doesn't do one of those two things, it's basically just noise.
But being relevant isn't enough on its own. The information also has to be a faithful representation. This is huge. It means the numbers have to reflect the true economic reality of what happened, not just some technical, legal version of it. To do that, the information has to be complete, totally neutral, and free from error. It has to tell the real story.
All right, so we've got our goal and we've got our quality standards for our materials. Now it's time to get to the fun part, the actual building blocks. These are the 5 core elements that are used to construct any company's financial story.
And here they are, the big 5. Assets are the resources the company controls. Think cash, buildings, machines. Liabilities are what the company owes to others, like loans. Equity is simply what's left over for the owners after you pay off all the liabilities. And then you have income and expenses. These are the things that make that equity go up or down over a period of time. Simple as that.
And this is the glue that holds the entire system together. The accounting equation. It looks so simple, but it is incredibly powerful. It says that everything a company owns, its assets, is either claimed by its creditors or by its owners. This equation has to balance, always, no exceptions. It's like the law of financial gravity.
Okay, so we've got our building blocks, but our blueprint still needs some instructions, right? We need to know 2 things. First, when do we add a block to our financial structure? That's called recognition. And second, what number do we write on it? That's measurement.
The framework makes that when question pretty straightforward with a simple 2-step test. First, you ask, does this item actually meet the definition of an asset or liability or one of the other elements? If the answer is yes, you move on to step 2. Will actually putting this on the books provide useful information? Is it relevant in a faithful representation? If it's a yes to both, boom, it gets recognized.
Now for the how much question. And let me tell you, this is one of the most debated topics in the entire world of accounting. How do you actually assign a dollar value to something? Do you look back at what it cost you, or do you try to figure out what it's worth right now, today?
The framework basically gives us 2 main paths here, and it really gets to the heart of a classic accounting tug-of-war. On one side, you have historical cost. This looks to the past. It's objective, you can verify with a receipt, it's simply what we paid for it. It's rock solid, but maybe not so relevant anymore.
On the other side, you've got current value, which is all about what it's worth today. That's often way more useful for making decisions, but it can also be a lot harder to pin down an exact number.
And just to make it a little more interesting, current value isn't just one single thing. It can mean a few different things depending on the situation. It could be fair value, what you could sell it for on the open market. It could be value in use, what it's worth specifically to your business operations. Or it could be current cost, what you'd have to pay to replace it today. The right choice really depends on the context.
So we've covered the objective, the quality materials, the building blocks, and the assembly rules. Now let's zoom all the way out and talk about the most important question of all. Why does having a single global blueprint for all of this matter so much?
The benefits are just massive. First, you get transparency. When everyone's following the same rulebook, you can actually compare a company in Brazil to one in Germany. It's a level playing field. Second, you get accountability. It closes the information gap, so investors can hold management's feet to the fire. And third, all of this leads to economic efficiency. When people can trust the numbers, money flows more easily to the best ideas and the best companies, and that helps lift the entire global economy. And really, this quote from the IFRS Foundation, the people who actually write these rules, it just says it all. Their whole mission is to create standards that bring transparency, accountability, and efficiency to financial markets around the world. It's all about creating trust. That is the incredible power of a well-designed blueprint.
So this framework gives us the perfect plan, the ideal structure for creating a true and fair financial picture. But here's the thing about blueprints. They're only as good as the builders who actually follow them. And that leaves us with a huge and, frankly, kind of scary question. What happens when companies decide to ignore the plan? What happens when they cut corners, or worse, decide to cheat the system? That's where theory ends and the real-world drama begins.